Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. And it's a good start, right, to Tuesday morning. Some follow-on gains. Third consecutive day where markets have gone ahead and hit record levels in the morning. And today, as we speak, the Nifty is now above 24,650. And the Sensex is just 150 points away from hitting that 81,000 level.
Hi, Reema. Yes, absolutely. It's been a green start. And once again, it's a pretty interesting market because we also have mid-caps performing. The advanced decline breadth is very healthy, actually. If you look at the advanced decline ratio right now, that tells you the other part of the story. Over 1,600 stocks on the advancing side, and there are just about 700 declines. There's plenty going on out there. On the large cap screen, just to sort of talk about the big movers and shakers, it's still the PSUs, the big boys, the ones with the maximum market weight. Coal India, BPCL, these are the ones that are really leading from the front. But then it's a very diverse, if you look at the Nifty contribution chart, then you have all kinds of stocks in it. I mean, you'll have some IT names, for instance, an Infosys, you'll even have an ICICI Bank. Though if you look at, the contribution, there could be some banks on the downside as well, Kotak being case in point. So it's a more mixed screen today. But for what it's worth, definitely more, movers on the way up than on the way down.
Okay, let's get to the market texture then and where we are headed. Rakshit Ranjan from Marcellus Investment Managers is with us on the show now. Rakshit, morning. Thank you for joining in. How are you feeling about the markets right now? What's the sentiment gauge and what's the investor appetite? It appears to be very high, but is there some nervousness creeping in?
Well, not so much in the style of investing that we follow, because we don't invest from one political outcome or one budget or one external event outcome to another. But otherwise, yeah, we're feeling quite positive because we can see a lot of opportunities where companies can allocate capital and make bucket loads of returns for investors, and that's where we are orienting our exposures to.
Can you talk about some of the recent changes that you've made to your portfolios?
Yeah, in fact, quite a few. Over the last 12 months, the number of companies or the allocation to companies that we call as sort of enterprising compounders with return on capital employed, not sort of 40-50%, but instead 20 to 30%, and reinvestment rates rather than 50-60%, more like 100% or 90%. So high on reinvestment and hence high on growth. These kinds of compounding plays have become more than half of the portfolio compared to, say, 10 to 20% that it used to be previously. And largely the reason for that is in the economy, we can see a very clear shift. What has happened is the way the digital and physical infra combined with the integration of the economy through GST and a structural fall of cost of capital because of physical investments going into financial. What it has done is there are challenger companies, mid-sized corporates, which are taking market share away from the larger incumbents in some areas. So, for instance, in our portfolio, we've got an Astral Poly as a recent investment, and Narayana Hrudayalaya in hospitals. And then you've also got some large companies spreading their wings, allocating capital to build new businesses. So Tube Investments is a case in point. Let's say a Chola expanding the turf, a Trent expanding beyond just apparel and getting into more groceries as well. So yes, those are some of the changes in the portfolio.
Okay, Rakshit, so I was going through your latest update, the July update, the newsletter, the Consistent Compounders, right? And it seems that you guys are now sort of tweaking strategy a little bit to go for companies that are not only allocating capital to their own core business, but also allocating capital to certain unrelated areas. Now, typically that's seen as a red flag by the market. But you seem to be liking, these big giants which are looking at newer business opportunities as well. Just explain that rationale to us. And I think an example that you cited in that newsletter is a Trent and a Tube investment. So just expand on that for the benefit of our viewers.
Yeah, so let me give you an example from, say, 3-4 years ago, so that there's also continuity visible in this change. So when we picked up a Titan 3 or 4 years ago, a Titan was highly energized around non-jewelry businesses, turning around its eyewear business, getting back the energy levels in the watches and wearables business, Tanaira as a sari business. These are not related to jewelry. These are, in some ways, unrelated businesses, right? When a Bajaj Finance was expanding from personal loans to home loans, consumer durables to home loans, that journey was not completely in related businesses. It was a lot of it in unrelated as well. That was not so widely available to us in our coverage universe. The number of Titans and Bajaj Finances of the world were just 2 or 3 options available to us, and hence the portfolio allocation was lower. All that has happened is in the last 2 to 3 years, we've identified several more Titans and Bajaj Finances, and Trent and Tube are 2 such examples that you cited from our newsletter. So in that regard, it's a lot more of what we were doing previously in lower allocations to the portfolio, doing it with greater allocation today. It does rev up the growth engine of these companies because the trade-off is higher reinvestment rates and maybe 5 to 10% lower return on capital employed compared to, say, an Asian Paints or a Dr. Lal PathLabs, which continues to be in our portfolio, by the way. Just that allocations have been slightly tweaked.
Particularly on Titan, do you think while the diversification strategy is well appreciated into Taneira, etc., watches, eyewear, on their mainstay gold jewelry business, competition is eating into the margins, and the stock has underperformed. It's down 16% from its recent highs, and year to date also it's in the red. Your view on Titan just in the near term as they navigate through these challenges? I know you guys are long-term investors, so you stay put. In fact, you've loaded up and tanked up more. But how should an investor or a retail shareholder understand how Titan is going to deal with these competitive pressures?
Yeah, no, you're right. The near term offers certain headwinds, and about 6 months ago, we more than halved the position size in Titan as a result. The headwinds are we can see two risks on the horizon, which are more near term. One, as you said, competitive intensity has arisen when the gold price is up. The second is also footfalls of customers. They start dropping for the industry as a whole if gold shoots up by 20 to 30%. If it's a far more gradual increase, footfalls are in fact benefited. But if it's a sudden increase, then customers start delaying their purchases a little bit. So that's the near-term piece. In the medium term, there's a lot of white space that this company is trying to exploit. So, for instance, when you look at the eyewear business, in 90%, 80 to 90% of the industry is below 6,000 rupee ticket size, and Titan is predominantly above that kind of a ticket size. So getting more into mass for eyewear, getting more into mass for wearables is a wide space that this company is going for. Carrot Lane adds a massive muscle to the whole Tanishq piece, and that's a massive growth engine. So from a medium-term perspective, from a long-term perspective, we are quite positive. But yes, as you rightly said, there are a few headwinds. A quarter or two. This is somewhat of a repeat of 2016. I remember in 2013 when a similar story played out. As you said, these things become opportunities to load up more. So at the moment, there's nothing on the long-term horizon that worries us on Titan.
Okay, so Titan over the long term, though you've reduced your holdings to an extent. By the way, the flashes on our screen just alerting us that there is this all-important meeting that's underway between telecom service providers and the telecom minister. This is happening in Delhi. And Ashmit has told us that, among other things, on the agenda is, of course, unsolicited phone calls and communication. That remains a very big issue, pesky calls. And perhaps the next stage of the big rollout beyond 5G, there lies 6G. So those are some of the issues that could be brought up in discussion. We'll touch base with Ashmit. He's right now in the ministry, in the thick of the actions. As soon as he manages to come out, we'll touch base and have a word with him. So a lot of the representatives of the telecom sector attending that meeting. Rakshit, just to round up this conversation, and since we were looking at that list of holdings that you have, of course, one of your long-time holdings has been HDFC Bank, right, and consistent compounders. Now, like with many other parts of the market, this is one stock, one enterprise that has been really testing the market's patience ever since the merger happened. And even, the last quarterly update was not really firing up the charts. We know that. There's this tactical issue, of course, of FPI allocation. But beyond that, what are the expectations you're working with? Will this be the year, the turnaround year for HDFC Bank? What's your base case thesis here?
Well, we hope so. We hope so, although it's very difficult to call a 6-month, 12-month share price trajectory on a stock like that. Yes, I think last 2-3 years, it's been a sequence of slightly uncorrelated events, right from a regulatory ban to a bottom of the NPA cycle for the entire banking system to this corporate action of the HDFC Limited merger, and then the entire lack of liquidity on the deposit side in the system, making it difficult for deposit growth of a bank like this. So all of that is behind us. We believe another quarter or two, none of these factors should have a drag on reported fundamentals. From a long-term perspective, I think the credit aspect, the credit quality aspect, is fairly cyclical. When the sort of credit quality peaks out or NPAs bottom out, that becomes a very attractive point to benefit from investment in a firm like an HDFC Bank, which is pretty much the rationale why we've continued to hold on to our exposure here. And yes, hopeful of better times ahead from an investor perspective on this portfolio holding.
Thank you, Rakshit, for your candid conversation today. With that, we'll slip into a very short break. We'll come back and discuss commodities on the other side. Stay tuned.
Let's now shift the focus to the commodity markets. We have Manisha Gupta joining in with the latest. Manisha.
Well, thank you for that, Surbhi. I want to talk about the gold imports within the country, which are coming in the garb of platinum, because there's a definition under CEPA which says that if there is a 2% of platinum or alloy containing 2% or more of weight of platinum, it is treated as alloy of platinum. Now, the thing within this is that when you are importing precious metals into India under CEPA, the import duty on gold is 15%, while the import duty on platinum is just 5%. So there have been various big bullion dealers and jewelers with big credit lines and offices globally who have been making use of this loophole into the system and importing a lot of gold via this itself. From what we understand, that in the garb of gold, platinum, which was last year imported at around 10 million tons, has come into the tune of 11 million tons already in the first 4 months of this year itself. Now, what we also understand is that this has distorted the Indian markets in sense of gold imports. We absolutely import all the gold that we use and consume in sense of jewelry, bars, coins, investments, ETF backing, etc. So there are multiple layers of import duty when it comes to gold. It's 15% as it stands right now. Then there is a different duty when you are importing it under FTAs, different duty when you do it with least developed countries or LDCs, as it is called, and then CEPA as well. So what we also understand is that because gold is coming in under so many layered and multi-layered duties, it is also on a discounted note within the Indian markets. So until last fortnight, gold in India market was at a $10 discount. Today, it is at a $34 per ounce of a discount. And a lot of gold has come in into this as well. What we also understand is that today itself there is a meeting happening with various gold association with the government, who is now seized of the nature and trying to correct this loophole. So there is something that we could hear pretty soon onto this one. But at this point in time, there is multi-layer in sense of gold import duty, and that has led to a lot of gold coming in into the Indian markets, as we have seen in 2024.
Thank you very much for that. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar will join in with his top trading bets. Stay tuned. Welcome back. Steady as she goes, 26,640 on the Nifty. On the mid-cap end of trade, quite a few interesting movers. You've got Chennai Petro now up close to about 12%. Suntec Realty continues with its up move from yesterday. Remember, it reported the pre-sales numbers. The stock rallied. It's seen a good follow-up up move. Mitesh is now back with us for a technical check on the markets. Mitesh, which stocks do you recommend?
So I think, what's happening is that the index has been pretty okay. It's the side market which is still showing momentum, and I think the oil refining stocks are showing good patterns. We have some positions in BPCL and HPCL, but I'll recommend in IOC right now. I think that's also showing good traction on the upside. So keep a stop at 167.5. Look for targets of 180 to begin with, and maybe even eventually we can look at higher levels over here. While the Page Industry stock has also made a fresh swing heights off the day's high, but the pattern is very strong. So buy Page Industry with a stop at 40,400. Look for targets of 42,000.
Thank you very much for that. Oil marketing companies, remember, are higher because Brent crude prices have dipped below $85 per barrel, providing them that tailwind in terms of pricing. Let's move on now. As you can see on your screen, what we've picked up from sources, the Uttar Pradesh government has extended its electric mobility policy till 2027. For more details, Parikshit joins in. Parikshit, hi.
Well, yes, this was an ask by the automotive industry to extend this policy to 2027 because it was lapsing in October 2025. So the industry, in a way, wanted some clarity from the Uttar Pradesh government. What the government has done, that there were funds for incentives and subsidies for different categories of vehicle under the UP government EV policy scheme, which had not been fully utilized. So the government has made sure that this fund is revived and is available to the industry till 2027. Also, the incentives in the form of road tax waivers will also be applicable on electric vehicles and hybrids till 2027. But there is a catch right now. Currently, there is a consultation on within the UP government on applying a price cap to the range of the price range of vehicles which can be allowed the road tax waiver. So that clarification is yet to come by. Currently, the road tax waiver on hybrid cars is there. Yes, there is a little bit of confusion on whether more expensive cars will get this, or will this only be for cars in the range of 15 to 20 lakhs. All that is yet to be clarified by the UP government. Currently, that road tax waiver continues on paper, and we will be awaiting a clarification from the UP government, which is expected to come soon.
Okay, thank you very much for that. Get into a break, but here is our special, which is coming up tomorrow, Wednesday, 9 a.m. A big offering, a CNBC TV18 exclusive. Well, just ahead of the budget, one of the world's top market strategists is in our studio. Chris Wood of Jefferies will make his bull case for India. And also, don't miss out an exclusive chat between Chris Wood and D Street stalwarts Ramesh Damani and Utpal Sheth. All this Wednesday, 9 a.m. Block your time.
Welcome back. Let's put the spotlight on L&T, and that's because of a very interesting development. Now, L&T's debt ratings are higher than the Indian sovereign ratings. In fact, both agencies, two of these agencies, Fitch as well as S&P, they have rated L&T at BBB+, which is 2 notches higher than India's sovereign ratings, which stand at BBB-. And to my memory, the only other, I think, company that enjoys this position is Reliance Industries, where the company's ratings are higher than the sovereign ratings in terms of India. What does this mean for L&T? Let's ask Amit Anwani, research analyst at Prabhudas Lilladher. Amit, great to have you with us on the show. So, of course, it sounds fantastic, but actually in terms of downright business, what does this imply? Does it necessarily mean lower borrowing costs? I mean, how should we interpret this?
Yeah, so Surbhi, I think there's been news that one rating have even better, only 2 companies, Reliance and L&T. So I think this is pretty important in 2 contexts. One is that L&T has been very aggressively focusing on the Middle East market, including Saudi, Kuwait, and Qatar. And we saw last year there was few mega orders which was won. So out of the 70,000 crore order which came in hydrocarbon, I think there was one large order and also one large more than 25-30,000 crore order in renewables. So I think more than 60-70,000 intake from the Middle East market. So this was very critical in terms of funding the project and financing the project. There would be support required from the international banks in terms of debt funding in these projects. And it was very important to have it at a lower cost. So in that aspect, since the execution period for all these projects would be next 3 years, this is very critical and enhances the overall funding management for these projects.
How much lower do you think the funding costs can be now for overseas?
Yeah. So I don't have the exact details, but I think this should be about 30-50 bips at least lower than the
30 to 50 bips.
Yeah.
Okay. So is there an EPS implication, or do you think this warrants a relook at the kind of valuation multiple you ascribe to L&T?
See, EPS, so there are also talks about that since there's a longer term spending plan by Saudi in renewables and oil and gas sector, and including urban infrastructure. We saw Neom City, there was few projects awarded to Indian companies, including L&T. So I think in that aspect, even L&T is targeting further orders, aggressive orders, large size orders in FY25 and I think FY26 as well. So we saw they surpassing the inflows guidance by a large amount, so more than 30% inflows guidance, and the share of Middle East market went up from 25% contribution to almost 40% contribution in the intake. So I think with that aspect, the top line definitely will see faster visibility. So with the previous assumptions of 10-12%, this can be more than 12-15% for next 3 years. And definitely some positive implications would be there with respect to the EPS. But having said that, I think near term, there are a few challenges which company might be facing in terms of labor's not availability challenge in past 2 months. But I think in second half and FY26, definitely we can see much better prospect, and there could be order intake surprise this year as well. So the company is guiding about 10%. I think with these Middle East orders, there could be surprise as good as last year.
Sure. So yeah, we've got the FY25 guidance up on our screens, and you're saying that with a better rating, maybe they get more overseas orders and surpass that guidance. Got that point, Amit. Just very quickly, since we have you with us, Q1 is round the corner. What are your expectations? And with L&T, the problem is never more orders. The market's issue continues to be on margins, right? And when they can start improving that margin profile. What are you expecting this year from L&T?
Yes, so definitely. So there was a margin impact full of FY24, I think by 70-80 bips. And they kept lowering the guidance full year. So there were a few specific challenges for company as big as L&T, more than 900 to 1,000 project sites. So definitely, I think the infra business was facing challenges last year, and because of the some competitive intensity in domestic market and slow pace of ordering did impacted the margin. So I am expecting. Starting Q3, Q4 of this year, there could be visible improvement which can be seen in the margins. And we are taking some 30 bips, 50 bips improvement in FY26 and similar kind of improvement in FY27.
Thank you very much for joining in, Amit, on L&T. Get into a break. On the other side, we'll talk more about stocks, sectors, themes. Harshit Kapadia from Elara Capital joins in. Welcome back. Now, the capital goods sector saw a record run in FY24. But does the sector have the power to rally further? Vamakshi joins in with the key expectations for Q1 FY25. Vamakshi.
FY24 was a blockbuster year for most product companies in the industrial space. It was characterized by record high order books, strong government-led domestic capex momentum, which offset the slowdown in exports and margin surprises. In the first quarter of this financial year, the top-line visibility across segments is very strong. Revenue is expected to grow in double digits, driven by execution of orders received in the last couple of quarters. While operational efficiency, favorable mix and better pricing could support margins, though a rise in commodity prices could place spoilsport. Nevertheless, margins are expected to expand on a YOY basis. Companies may continue to benefit from a strong inquiry pipeline, especially in T&D, data centers, EV, railways, amongst others. However, order inflows may see some moderation given the elections, which is largely expected. For ABB, process automation and electrification segments are expected to drive growth. Order backlog of nearly 8,900 crores will support revenue growth of nearly 23%. With the base quarter EBITDA margin at 13.9%, we anticipate an expansion of nearly 330 basis points, resulting in a 46% uptick in the net profit. For Siemens, the company could see its revenue rise by 19% on account of healthy growth in smart infra and mobility segments. Margins may expand by 240 basis points to 14%, but UBS believes that the company has the potential to deliver a surprise. Clarity on HVDC orders in energy segment and large tenders in mobility remains critical for this company. CG Power seems well placed to capitalize on continued capex-driven demand from industrial and power segments. We expect the company's top line to grow by 20%, margins to remain more or less flat, down 10 basis points. But Nuvama believes that the company's margins may remain weak for the next 1 to 2 quarters. We will also be watching out for clarity on exports ramp up with expanded capacities nearing completion. As far as BHEL is concerned, Bank of America expects strong order inflow of 30,000 crores this quarter. We anticipate a 13% growth in the top line and 380 basis points improvement in its margins. In fact, Bank of America expects EBITDA break-even from this quarter itself if execution momentum sustains. As far as Cummins is concerned, revenue growth of 10% is expected to be driven by robust domestic demand, but exports may remain weak given slower recovery in end markets. With rising share of CBCP4 gensets, margins are expected to rise by 360 basis points on a YOY basis. Apart from that, management commentary around demand outlook, transition to the new norms, and any competition-led margin pressures is critical to monitor. It is also important to see whether margin surprises, as seen in the past few quarters, is able to sustain. Most of these capital good players have seen continuous upgrades on account of the pickup in ordering activity, growth in the top line and profitability, which has driven a re-rating in the sector. Valuations, as you can see, for most players are above the 5-year average. Nevertheless, UBS has maintained its positive view despite expensive headline valuations. Additionally, Nuvama believes these premium valuations are warranted given the capex supercycle.
Okay, all right, premium and how? 100 times. Who would have thought we will live in an era when we see those kind of earnings multiples for capital goods players? Vamakshi, thank you very much for that backdrop. Much appreciated over there. We have Harshit Kapadia from Elara Capital now joining in to take this discussion forward. Harshit, great to have you on. That's really the question, right? I never thought in my career I'm going to see 97 times or 100 times for a capital goods stock, right? But here we are having this conversation. So you tell us, from an earnings standpoint, what is the run rate that these companies will have to keep throwing up to justify these numbers? And do you think we will have evidence of that kind of growth in this quarter?
Yeah, morning. So to have a justification of such a high valuation, we expect an earnings CAGR of close to around 25% on a consistent basis. And the kind of capex momentum that we have seen across multiple sectors is giving us this kind of a support. That's where these kinds of companies are trading at such a high and rich valuation. But any miss out would be something which could be really not looked at positively.
You know, Harshit, the fear is that maybe margins have peaked out for some of these companies because raw material pressures have started creeping in. Does that, put some pressure on the EPS expectations?
Yes, that do see some compression on the EPS side, but that would be passed on to as subsequent quarter comes up, given that the demand environment is extremely strong. So there could be subdued quarter for maybe fewer quarters, but post that there could be a recovery is what we have also seen in the last raw material cycle, which happened from 2022 to 2023.
Harshit, you said that obviously, 25% is the run rate that's going to be required to keep justifying these kind of valuations, right? So let's talk about where this 25% growth is going to be delivered from, which pockets, and from an investor standpoint, which are the areas that we should track more closely? I mean, I don't know, data centers, or should we look at power? Because even in power, there is so much of capacity that's being added. So should one be focused on power equipment companies as industrial automation? So which are the segments which are the key focus areas for you that you're tracking, and which are the companies that represent those sectors or that have a greater exposure to those sectors?
Yeah, so rightly you mentioned utilities has become a very important, both thermal as well as renewable, given that the manufacturing base is rising. So that has been a predominantly the major sector. This is followed by data center as being another sector which is seeing an unprecedented momentum in terms of growth, both domestically as well as there is also a market on export side which is rising for renewables as well. So that is also propelling us growth for the sectors. And apart from that, if you have looked at oil and gas, the core economic sectors, which is oil and gas, metals, as well as cement, has also started to inch up their capex guidance, and that is also helping us believe that the growth is going to be there.
So in terms of your own projections, which companies in the ones that you cover are likely to post a 25% plus kind of a top line growth?
So within the companies which I cover, ABB looks to be on a very strong footing as far as the quarter is concerned, followed by Siemens. Siemens would be somewhere close to around 18% growth. Thermax would be something close to 15%, as well as cable and wire companies looks to be at a 20% kind of a growth. Given that Q1 is generally a very soft quarter as far as capital goods is concerned, second half is where the major growth comes up as far as the sector is concerned.
Actually, I was asking more from a longer term, because you spoke about 25% over the next 5 years. So which of these companies, Q1 aside, can report this kind of robust, consistent growth?
So within the companies which I cover, it would be Siemens, KS International, KI Industries, Thermax are the companies which I would prefer and which would see a consistent growth of 25%, given that they are in a super cycle of industrial and their product portfolio is very much aligned to what the power requirement is, towards how the changes which are happening on the power side, moving more towards non-fossil environment as well.
Siemens, KEC, KEI and Thermax, right? These are the 4 companies. And these are your top picks?
Yes.
Okay. Thank you, Harshit, for the conversation today. We will slip into a very short break. On the other side, we bring you excerpts from our conversation with the management of Bank of Maharashtra. Welcome back. Telecom stocks are doing very well today. So Bharti Hexacom is up nearly 5-7%. JP Morgan has initiated coverage. They've put the target price at 1280. IFL2 has initiated coverage in Bharti Hexacom. Their target price is at 1267. They both believe that the best way to play the market repair or the tariff increase story in India is via Bharti Hexacom. But even a Bharti Airtel or a Vodafone Idea are moving up. So if you pull up a Bharti Airtel, that's up close to about 2%. Vodafone Idea has some strength going for itself. So the rally is sparked because the Supreme Court has agreed to hear the curative petition on AGR relief. If you see the current pending AGR dues, it's 70,000 crore rupees for a company like Vodafone Idea. For Bharti Airtel, the pending dues are about 36,000. If they get any kind of relief on this, and the street is assuming 50%, it's a direct boost. It's a cash flow benefit. They don't have to pay those dues going forward. So there is upside in the stock. according to analysts. So according to, we were talking with IFL's, telecom analyst Balaji, and he said for Vodafone Idea, if they get a 50% relief on their pending AGR dues, there could be an upside of 5 rupees. And for Airtel, there could be an upside of 30 rupees. Not from current levels, but generally the relief amounts to 5 rupees per share on Vodafone Idea and 30 rupees for a company like Airtel. So telecom stocks today are doing pretty well. But the one which is on our radar right now is Bank of Maharashtra. Reported their Q1 numbers yesterday. The asset quality and the net interest margin continue to remain stable. My colleague Abhishek spoke to Nidhu Saxena, the MD and CEO of the bank, and started by asking about the deposit growth. Listen in.
The industry is currently encountering a very intense situation where the credit growth is outpacing the deposit growth in the system. And I'm also not out of the system. Like if you see my numbers, my credit is expanding YOY 19%, whereas deposit I could get at a YOY growth of 10%. But having seen the situation, we are taking a lot of steps on an immediate basis, and some things that we'll be planning to implement in the near term, so that some results will come. So what we are specifically trying to do is what I will try to explain here. We are having good patronage from state government departments, ministries, many institutes in Maharashtra and outside Maharashtra as well. I am able to see some traction in 3 months, and people are responding, and we are getting some green shoots. And I'm only going ahead strengthening this effort. And so this will take care of broadly institutional deposits. At the retail deposit level, we are doing a couple of measures. I have seen that powerful digital channel is mobile banking. So we are working on making digital banking more customer friendly. And in fact, going forward 6 months to 9 months from now, there'll be a lifestyle banking application that we are launching, which will be a new version providing additional services.
Sure, sir. You spoke about, loan growth outpacing the deposit growth. We have seen that for the banking system as a whole since April of 2022. Now, credit growth has outpaced the deposit growth. Talking about your own credit growth, how has it been segmentally? Where are you seeing demand from? And by when do you expect, the proper capex cycle in the corporate portfolio to come back?
Yeah, Abhishek, that's a good answer. The good question from your side. We are also trying to find answers because we have been discussing this, we've been hearing this. And yes, the private capex cycle in true sense is yet to be seen, maybe next 2 to 3 quarters. We expect that demand coming from the corporate and I see that manufacturing sector has to really come up and, for capex in the private sector, it is still something which we'll be awaiting and maybe next 2 to 3 quarters. But other than that, we are seeing a lot of traction in the RAM segment. Our retail, agri, MSME, they are having healthy double-digit growth.
While net interest margin has remained healthy on a sequential basis, we are in a rising cost of deposits or cost of funds scenario. And, I'm still waiting for your answer whether you have heard from RBI with respect to credit deposit ratio at 75%. So how do you see, net interest margin panning out ahead if at all you have to put your CD ratio, that is credit to deposit ratio, at 75%?
So let me just clarify, Abhishek, here. There is no regulatory prescription on the CD ratio as such. But yes, the regulator is watching this parameter, how it is moving. And from 75, we are now at 78.16. And I think that's a healthy ratio, 78, 79, we would like to maintain to see that my net interest income is going up. So there is no discomfort to me in maintaining a CD ratio of around 78 to 80 between. I don't think so there's a problem there. And yes, deposit, as you said, I already explained a lot of, to fuel this credit growth, we require a lot of resources. And currently, although if you look at my capital adequacy, we are at a comfortable zone. But I have my plans in place We are also exploring raising for my infrastructure book that I am having around 27,000 crores. So I will be going to board very shortly, and we will try to do one tranche of raise through infra bonds also. So where we get the advantage of CRR, SLR requirements are not there, and my cost of borrowing also will come down, is what the sense is coming to me. So we'll explore that option too.
So what is the guidance on net interest margin trajectory?
So we are keeping a guidance for ourselves of maintaining a NIM between 3.75 to 3.9. Although I'm doing 3.97 for the last 2 quarters, I don't see much of challenges, but I want to be conservative here and keep a guidance of 3.75 to 3.9.
Well, that's very good, sir. Now, slippages marginally increased on a sequential basis, which is seasonal in nature, but your credit cost spiked up. So, provisions for NPA spiked up by 28% on a sequential basis. What was this provision for, and how do you see the outlook with respect to slippages and credit costs going ahead?
Yeah. So, let me clarify here, Abhishek. The issue is that I am already an NPA at 0.2%, and I'm maintaining that level. So whenever I'm encountering any slippage, I am required to provide more than the regulatory prescription, and I am doing above that. So if you look at credit cost, as per the IRAC norms, it works out to only 0.4%. And yes, the credit cost for June has been 1.12, which is on Q1Q sequential basis has gone up. But this is on account of slippages in the agri segment, which is, I think, not something we are not able to control. We have seen this trend in Maharashtra in previous years too. And going forward, I'll be definitely able to control this. We will be able to even recover and upgrade a lot of agriculture accounts that have slipped in this Q1. And that also will, be able to rectify the position.
Well, what I've observed with bankers are that agri portfolio has been hurting for last 2 quarters in a row, Q4 as well as Q1. And what I'm seeing on the NBFC side, the MFI portfolio is hurting them over the last 2 quarters and is expected to hurt going ahead. So do you foresee pain in the rural economy that started to kick in because of high inflation? And how do you see your gross NPA and net NPA levels by end of FY25?
Okay, so yes, see, we have done at our level certain, changes. What we have done is we have changed our focus when we look at the agri segment from the production credit to investment credit. We all have read about a good monsoon this year. So if the rainfall is adequate, I'm sure the sector will not going forward see any much of stress, and prospects will only improve going forward.
Interesting conversation there with Bank of Maharashtra. While the indices are consolidating, stocks underneath are bubbling. So some of these cement companies catch your attention, a Heidelberg Cement, and the other one is KCP. Stocks are up 5% and 4%, pretty large volumes. NOSIL is another one, just volumes at 3 lakh already. And it's been about 2.5 hours of trade. So NOSIL is higher. In the banking pack, it's Punjab and Sindh Bank where you are seeing a spike up. Castrol India gains for the 2nd day in a row. I think yesterday and today combined, the stock has seen an up move of 10%. This month, Castrol is up nearly 38%. It's seen a phenomenal rise in Aadhar Housing Finance. We chatted with the management earlier today, and they were telling us that they'll be a beneficiary if there are any tweaks, benefits to the Pradhan Mantri Awas Yojana, the one which is for affordable housing. So they're going to be watching the budget very closely. They've made representations. Aadhar Housing Finance too, higher by nearly 5%. With that, it's a wrap on Trading Hour. Stay tuned. Halftime Report is up next.